Good afternoon, StaaS investors. Let's talk about some inside ball. One of the questions that we've always got over the last couple of recession cycles is how does Bitcoin correlate to other asset classes? Now, when it comes to Bitcoin to other assets, you might look at it and it looks like a bubble, but in reality, well, let's see. These days, as always, the mainstream news is full of Bitcoin is a bubble opinion pieces, argued from the outside looking in. The rationale usually comes down to Bitcoin having no intrinsic value. It does. In reality, fiat doesn't. Or a contrived interpretation of whatever Bitcoin's price has done lately. For example, you've probably seen things like BTC has risen. This is just like tulip mania. It's a bubble. BTC has fallen. See, we told you it was a bubble. BTC has neither risen nor fallen. Nobody cares about Bitcoin anymore. It's eventually going to zero. Guys, I've been through this for a decade now. Bitcoin is in a bubble has been the consensus view of the mainstream news since the beginning. And in my opinion, it holds very little weight. But just because the rationale doesn't hold up, that doesn't mean Bitcoin is definitely not or act like a bubble. The sharp rally and sell-off of the last few months do seem, at least plausibly, a bubble-like. But there is no way to know definitively whether or not Bitcoin is a bubble. But here are a few metrics that I want you guys to look at. And these really help us understand how the institutions are moving money. You see, Bitcoin really does look like a lot of other asset bubbles. The other day, for example, I tweeted out a graphic comparing the price history of Bitcoin to NASDAQ during the rise and the fall of the dot-com bubble. The timescale is not the same. NASDAQ took years to reach its peak, while Bitcoin rose 20x in less than a year. But the patterns do look eerily similar. The charts both begin with a steady rate of ascent, followed by a kink where the slope shifts upward and the growth takes off. At the top, they both show the same double peak pattern, the first one taller than the second, and then they begin to fall back down to earth. By that time, the NASDAQ finally had reached the end of its decline. Nearly all of the gains it had accumulated during the dramatic rise had been lost. So, does a similar fate await Bitcoin? Well, the historical similarities don't really end there. This next chart is from Dr. Jean-Paul Rodriguez' research on market booms and busts. He explains the pattern by breaking the lifespan of a bubble into 4 stages. Compare this chart right here with the ones above. It's nearly an exact match. The time span and amplitude of market bubbles have varied over time and across different asset classes, but this pattern has repeated over and over and over again. For example, here's the S&P 500 index before and after the crash of 1929. You can also see the same pattern in the gold bubble of 1980, Japan's stock market in the late 80s, the Shanghai Composite Index in 2007, and many other asset bubbles. If you squint, you can see the same bull trap double peak pattern in the US home prices in 2006 and 2007. And as you guys well know, the US home prices in 2007 were every bit as much of a bubble as NASDAQ was in 2001. But the price trend looks very different. So, what's the difference between a bubble and a normal market fluctuation? Most would agree that the US housing market in 2007 was most certainly a bubble. But in terms of the price decline, it was not as nearly as severe as the other bubbles shown previously. From its highest point to where it bottomed out, the US housing market lost about 25% of its value. Compare that to the dot-com bubble where NASDAQ lost 78% of its value, or the stock market crash of 1929, where by the late 1930s, the S&P 500 had fallen by 85%. Even more extreme, compare the US housing market to Bitcoin, which can move up or down 25% or more in a single day. And it does so regularly, about 8 times per day since 2013 to be precise. For Bitcoin, a 25% fall would not indicate a bursting bubble, but a normal price fluctuation that you would expect to see a few times a year. For the US home prices, which were historically very stable, a 25% fall is a once-in-a-generation event. Bitcoin is and always has been a volatile asset. The chart below, or the chart right here, shows how its daily fluctuations over the last 5 years compare with the NASDAQ, the S&P 500, and the US housing market over the exact same period. Let's look at the daily volatility of each market. Bitcoin, 4.8%. NASDAQ, 0.89%. S&P, 0.76%. And Case-Shiller, 0.4%. On average, Bitcoin's price fluctuates 5 times as much as NASDAQ, 6 times as much as the S&P 500, and over 100 times as much as the US housing market. So, is Bitcoin a bubble? The short answer is nobody really knows. Even myself, having been into this game over 10 years, Bitcoin looks and feels like a lot of the other market bubbles from the past, and it has all the hallmarks of a bubble. Speculative buying, fear of missing out, a sudden frenzy of interest from the general public, generally pushed by mainstream media narratives, right? The recent price decline is big, even by Bitcoin standards, but not out of the normal range of normal given its past fluctuations. And this is why we, over the last 2 funds, have made exceptional returns by investing deeply during these recession periods. Bitcoin is a highly volatile asset, far more than any other financial markets we were accustomed to following. And we should be careful applying the same intuition to make predictions about its future price. So where does StaaS Fund play in all of this? Very simply, we have been in the market cycles since 2011. We've been through all 4. We have profited off the last 2. And this cycle, the 3rd one that we're going through, we're going even bigger. So for us, we don't really care so much about the cycles, other than the fact that when the cycle is up and starts coming down, that's when we start paying attention so that we can invest even more and mine even more Bitcoin and invest even more deeply into infrastructure so that a couple years out, we're mining 4 to maybe even 12 to 15 times more Bitcoin than anybody else. This is why we have been winning for the last 5 years. Thanks, guys. Be encouraged.